Hi, I'm Harper Jones with Life with Leverage, and we coach you on the infinite banking concept and how you can become your own banker. I've gotten a lot of questions recently about the different types of insurance out there in the life insurance realm. We have term insurance under one umbrella, we have permanent insurance under another umbrella, and there'll be different products under the permanent insurance that we will get into. Before we get into permanent, let's start with term. Okay, what is term insurance? Term insurance, in essence, is you're paying a set premium each year for a set death benefit, okay? Why is term insurance so cheap? Because the likelihood it's going to pay out is very, very low, in the realm of around a 1-ish%, give or take, okay? It's very profitable for the insurance companies, and you're essentially betting against the insurance company that, hey, you're saying, I'm going to die, and they're saying, no, you're not, when they're using the law of large numbers. Now, not to be morbid, but that's objectively how they'd look at it. So, what does that mean? It means that you still may need term to have the coverage. I'm not saying don't have it, but for the long term, it's not going to be great because you're not going to get cash value accumulation. You're not going to have any other benefits with the policy. You may be able to borrow against the death benefit if something were to happen, if you were to have like an illness, critical, a chronic, or terminal. But if you're going to need some coverage, you can always start with a term or use that if whole life, for example, or the infinite banking concept doesn't make sense for you, or any of these other products that we'll dive into under the permanent umbrella. One key note is if you do get a term and lock in your insurability for that term, which could be a 1-year, 10-year, 15-year, 20-year, 25-year, 30-year term, you could have what's called a conversion rider. And if you have a rider in there, it'll allow you to convert for the period of the term or a part of the period up to that death benefit. So let's say you had $1 million in death benefit in a term, you can convert $500,000 or $750,000 or $1 million of that term into a permanent product if that company allows. Now for us, we work with mutual insurance companies. Why? Because if you were to have a whole life, you get to participate in the profits or the dividends of that company, and you're really part owner. But let's dive back into permanent insurance now. So we talked about term. Now let's go on to permanent. Under the permanent umbrella, you're really betting with the insurance company, specifically with whole life. Now, I'm not telling you, hey, get a whole life or hey, get a universal life or a different product. The point of this video is just to have a basic overview of the different types. Under the permanent umbrella, whole life would be best for the infinite banking concept, but that may not be what you're trying to achieve. Me personally, I'm only writing whole life policies and none of the other three. And you have universal life, index universal life, and variable universal life. Okay, so to look at them, one simple thing to keep in mind that whole life is going to have much more guarantees. And it's going to be more of an ideal savings vehicle, whereas the universal, index, and variable universal lives are going to be more investments, have some more risk with it, and be indexed or more tied to, say, a market, okay? It's not going to be as predictable, not going to have as many guarantees, not going to be as reliable long-term for any income replacement, estate planning, or long-term projections on death benefit and cash value accumulation. With that said, there can be a time and a place for the other products if that's what you're looking to do. Once again, us at Life with Leverage, and me myself, I don't currently use those products. I don't plan to use those products, and I have never written those products. Let me get some basic definitions here of the other three. So universal life provides the flexibility of varying the amount of your premium payments and a guaranteed minimum death benefit as long as your paid premiums can cover it. Very key right there. If you don't keep up with the minimum payments, your death benefit payment can be reduced or the policy could lapse. This type typically offers lower premiums and more flexibility than whole life, but weaker guarantees and cash value growth potential. Okay, what's that mean? Essentially what I just said. You don't have as many guarantees, and you're not going to have as much predictability long term. There's going to be a little bit more inherent risk. And all these other three types of policies didn't come around until, say, around the 80s, so they've only been around a handful of decades. Now, I'm not going to go into a lot of specifics on these different types of policies because that's not the point of the video, just a basic overview, but I may do that in the future. Index universal life is very similar, except you're going to be indexed, say, to an S&P 500. So you have your insurance cost over here, then essentially you have a side account basically that's going to be indexed to the market, say S&P, right? And you'll have what's called floors and caps. So you might have a floor of 2% and a cap of 10%. What's that mean? If the market goes up 15%, you only get 10, and if it goes below 2%, you get capped at 2. Now they're still going to have other costs, which could be fees, or it could be other mortality costs, and those could vary over time because you don't have as many guarantees like you do with the whole life. So that's when you see an illustration in, say, an index universal life, you'll see a guaranteed, a midpoint, and then current projections of what they project out. So to recap, whole life's going to be better for savings, and the other three could be a little bit better for maybe an investment if you're trying to look at that and tie it more to the market with some more risk. For me, if it's insurance and it's more savings, we want to have predictability and guarantees long term. Another thing is borrowing. With whole life, you could have a fixed rate or you could have a variable rate. Either way, with universal life, index, and variable, you want to make sure, hey, when you're borrowing, is your money still invested, or are they actually taking it out of the market, which they do at times, or maybe they have different options. And say an IUL can be a little bit of smoke and mirrors. Why? Because they say, hey, you might have 6 or 7% return, and they're compounding that annually each and every year. But the market's not going to be linear. The market's going to be up and down, and an average return is not the same as a compounded average annual return. Universal life and those other products are a little bit more of a profit center for the insurance companies. And whole life, you're really teaming up or partnering with the insurance company as a whole because you're participating in those profits. Then another thing I always like to see is someone does have a universal life or they're selling them. Tell them to run in-force illustrations for their universal life over, say, the last 10 years and see how accurate they've been from the original projections. That's always great to look at because most of the times they're not very similar, or they're lower or not performing as illustrated, even though the market's done well. And then if you're looking for income stability later on in estate planning, you don't have as many guarantees as other products, so I like to stray away from them. Once again, could be a good fit if you want to see if you can have a little bit more upside. But for me, why don't you just put it in the whole life, borrow against it, then toss it in the market, and you're getting both assets that way. And at the end of the day, when I'm looking at all this, I look at universal life and these other products versus whole life as there's some other things you got to look at, like an illustration. If you're paying a certain premium, if you ended up wanting to surrender the policy, you're going to have more charges. Whereas with whole life, you're not going to have as much what would be called like surrender charges right earlier on. And that's something you want to factor in as well. So if you have any questions, want to dive in, I'd be more than happy to. You can check out our website at lifewithleverage.com.